You're lying in bed. Lights off. Phone brightness turned down so low it feels illegal. You open your investing app. Not to trade. Not to do anything reckless. Just to look. The number spins for a second longer than usual. Your heart does that annoying thing where it speeds up for no reason. And then it lands. There it is. 5 figures. Not if the market doesn't move overnight. Not pending transfer. Actual money. Invested. Working. Yours. Your shoulders drop. Your jaw unclenches. For the first time, you feel ahead. You start imagining what this means now. I'm finally doing it right. I should probably level up. Maybe I should get more aggressive. And right on cue, the world smells blood. Your brokerage app flashes a banner. Top investors also buy this. Your bank emails you about and use capital. Your feed fills up with people your age casually mentioning returns like it's weather. And your brain whispers the most dangerous sentence in personal finance. I'm ready for the next step. That's the catch. Because the moment you start investing, really investing, the rules change. Quietly, invisibly, the system stops punishing you for being broke and starts testing how well you understand what you're doing. This is where people lose money. Not because they picked the wrong investment, but because they use the right one the wrong way. Most investments don't fail on their own. They fail because of timing, behavior, expectations. There are investments that only work if you do them right. And most people don't even know there is a right way. That's what this video is about. 7 investments that can absolutely build wealth, but only if you understand the catch. Otherwise, they quietly drain you while you think you're being responsible. Subscribe to Anno Magic. Just fewer mistakes. Here's the lie we're all sold. That investing is about picking winners. Stocks versus real estate. Crypto versus index funds. This account versus that account. Like money is a shopping aisle. But investing doesn't work like shopping. It works like a roller coaster. Most people spend years just climbing the first hill, learning, saving, finally getting money into the market. And when they reach the top, they take their hands off the bar because the hard part feels over. But according to data from Vanguard and Dalbar, the average investor consistently underperforms the market by around 1.5 to 2% per year. Not because markets are evil, not because investing doesn't work, because humans panic. They chase. They quit too early. The problem isn't the investments. It's the behavior wrapped around them. Most people invest like this. Let's see how this goes. Which is code for, I have no plan, but I'm hopeful. Hope is not a strategy. It's a mood. And when a mood changes, when markets drop, when life gets expensive, when fear shows up, people sabotage perfectly good investments. They sell at the wrong time. They stop contributing. They shift strategies midstream. And then they blame the investment. But here's the uncomfortable truth. You can do everything right on paper and still lose if your expectations are wrong. And if that's you, if you've tried investing and it didn't feel magical, you're not broken. That's almost everyone. My name is Peter. I'm not a guru. I'm not selling a course. I don't think you need a whiteboard or a morning routine named after a Greek god. I'm just obsessed with how money actually works. Especially the parts that sound boring, feel slow, and don't photograph well for social media. Quick disclaimer before we go further. This video is for education and entertainment only. I'm not a financial advisor. I don't know your situation. Talk to a qualified professional before making financial decisions. Now, let's talk about why some investments only work if you use them correctly. There are 2 phases most people go through. Phase 1 is the grind. This is survival mode. You're saving. You're learning. You're proud just to have investments. Every dollar invested feels like progress. Then comes phase 2. Phase 2 is where things get tricky. You're no longer afraid of starting. You're afraid of messing up. Your brain shifts from defense to optimization. How do I do this better? How do I get more? And the system loves this phase. Because once you're stable, you're profitable. Brokerages push complexity. Banks push leverage. Apps push activity. Why? Because inactivity doesn't make them money. Here's the catch with the 7 investments people love to talk about. 1. Index funds. 2. Real estate. 3. Retirement accounts. 4. Individual stocks. 5. High-yield savings. 6. Business investing. 7. Alternative assets. All of them work. None of them work automatically. Index funds fail when people panic sell. Real estate fails when people over-leverage. Retirement accounts fail when people raid them. Stocks fail when people treat them like lottery tickets. Savings fail when people never move past them. Businesses fail when expectations are fantasy. Alternatives fail when people don't understand risk. After scarcity, reward feels justified. After instability, risk feels smaller. That combination is lethal. You don't blow your investments in one dumb move. You leak them, a tweak here, a pause there, a temporary change that becomes permanent. And slowly, quietly, the strategy that was supposed to save you becomes another source of stress. Not because you're bad with money, because the system is tuned to reward activity, not patience. Let's talk boring math, because boring math doesn't lie. Imagine 2 people invest $500 a month for 30 years. Same market, same returns. Person A stays consistent. Person B stops during downturns and waits for clarity. At a modest 7% return, person A ends up with roughly $600,000. Person B, hundreds of thousands less. Not because they invested less, because they interrupted compounding. The Federal Reserve's data shows that people who maintain consistent investing behavior, even during volatility, dramatically outperform those who try to time the market. Time in the market beats timing the market. Every single time. This is why boring wins. Not exciting, not viral. Boring, because boring survives fear. Let me tell you about Alex and Jordan. Alex discovers investing and goes all in emotionally. Reads everything. Tweaks constantly. Alex invests in good things. Index funds. Some stocks. A little real estate exposure. But Alex checks daily. Changes strategy yearly. Pulls back when things feel scary. 10 years later, Alex is tired. Not broke, but disappointed. Jordan starts slower. Less excitement. More rules. Jordan picks boring investments and sticks with them. Sets automatic contributions. Doesn't watch the news. Jordan doesn't feel smart. Jordan feels patient. 10 years later, Jordan has options. Not yachts. Options. According to Fidelity, households that follow consistent, rules-based investing are significantly more likely to reach long-term financial goals. Not because they knew more, because they touched less. So here's the real rule behind the 7 investments. 1. Pick investments you can emotionally survive. 2. Automate whenever possible. 3. Decide before volatility how you'll react. 4. Separate safety money from growth money. 5. Expect boredom, not excitement. 6. Increase contributions with income, not confidence. 7. Be suspicious of anything that needs constant attention. Money isn't about being clever. It's about being consistent. The Real catches this. Most investments fail because people expect them to entertain. They're not here to entertain you. They're here to quietly buy you time, options, and freedom. Use them correctly. Leave them alone. Let boring do its job. Because the people who win long-term aren't smarter. They're calmer.